Like having echo. Hello, everyone. Welcome to today's webinar, Navigating Global Equity Through a Sustainable Lens. My name is Saran. I'm head of distribution here at Genus Capital Management. And today I'm joined by Stephanie Tu, our Chief Sustainable Officer and Portfolio Manager. So while we're waiting for more people to join, I'm just going to go over some housekeeping items. Please maximize your screen for better viewing experience. And then if you have any technical issue, feel free to, what we find works is first close your window and come back. If that doesn't work, feel free to um, to basically reach out to us through the chat. We have one of our colleagues in hand that will be able to assist you. Feel free to put all your questions in the chat and we'll make sure to get to most of them at the end of the session. If we don't, we're also going to put our email address and LinkedIn link in the chat. So feel free to reach out if you have any follow-up question. While we're waiting, I'd like to start by extending my gratitude to the indigenous people, specifically the Coast Salish, Tsleil-Waututh, Squamish, and Musqueam, whose land we are honored to speak to you today. We do this to reaffirm our commitment and responsibility in improving relationship between nations and our own understanding of local indigenous people and their culture. So without further ado, let's get started. So what is the goal of today's session? Today, we actually want to hit on a couple points today. The first one is we see a big opportunity for advisors. And there is a historic wealth transfer that is happening. It's happening now. It's not numbers of the future anymore. And then that wealth transfer can be a risk or an opportunity depending on how the advisors are positioned. Um, and then we also see that there is shifting client expectation. Clients need more than investment. They need a holistic approach to their wealth. And the responsible investment gap is something that we see year after year. So it's still here. And then we believe it's a way for advisor to secure intergenerational transfer with younger generation and women. The second point is that we'll go over a successful advisor roadmap, how we believe advisors should be positioned to make sure they're capturing all these opportunities. And then finally, Stephanie will go through the investment tool. We'll go through one of our solutions, the high impact equity, which is a global equity solution, but mainly with the goal to go over our comprehensible, sustainable lens and then see how that's adding value on an alpha from an alpha standpoint and return standpoint. So let's get started. So what are the growth opportunity that we see there out there for advisors? So I'm sure you've seen these numbers before. The opportunity is huge. And as I said, this is happening now. It's saying that by 2026, it's expected that 1 trillion will be transferred from baby boomers to younger generation, and that women are expected to control close to 47% of wealth in Canada by 2030. So as I say, this is happening now. It's in a couple years, and then the transfer of hands has already started. So is that a risk or an opportunity? We really believe it depends how advisor position. It could definitely be a retention risk because Canadian advisors do report that they are able to retain client relationship only 45% of the time when client children inherit. And then many of the children end up firing the advisor after the inheritance. So there's definitely a retention risk here. So it's up to really advisor to mitigate that by making sure that they're involving that younger generation earlier into the process. We also see that it's definitely a growth opportunity as well, because 48% of Canadians currently do not have a financial advisor, which is creating a large pool of prospective clients as wealth change hands. And then we see the same thing in the responsible investment space where the service gap is still present. And then I believe it's 40 something percent. So definitely an opportunity there for advisor to take advantage of all these opportunities that we see. We think that the intergenerational transfer is a client growth opportunity for advisors. Wealth transfer is becoming a major source of new client acquisition. 51% of US advisors says that clients first engage them because of inherent asset. I was talking to an advisor the other day, and then she said that And most of our new clients are clients that come after a crisis. So it's either, a woman that lost her husband or kids that are inheriting from their parents. So the goal is really trying to get before that crisis happened. Advisors are increasingly expected to build relationship with client and their heirs, and then strong multi-generational relationship can improve retention and capture future asset. We also see a lot of shifting client expectation, and then to win that next generation of clients, advisors have to be able to adapt to some of these trends. I believe most family now expect holistic planning, so they are increasingly valuing advice beyond investment return. Key priorities nowadays include legacy planning, trust and estate, tax strategies, and then one additional thing that is on the list now is value-based investing. So we're just going to take a quick poll here, and then the question is, I'm curious what the audience think about the percentage of Canadian that want their personal values reflected in the financial advice they receive. So the answer are 20, 55, and 80%. It's interesting because most people are saying 20%, where the answer is actually 80%. 80% of Canadians say it's important that their personal values are reflected in the financial advice they receive, which is driving demand for ESG and impact-focused strategies. I think it's really an interesting number, and then it speaks volume. So the next generation is really interested to align their portfolio with their beliefs and priorities, and then I think this is something that advisors should pay close attention to for sure. The research also keeps showing that the responsible investing interests remain strong. And this is from the 2026 RIA Investor Survey. They do one every year. And then it actually showed that 2 in 3 Canadians remain interested in responsible investing. And then there's strong interest in the different ESG team, environmental, social, and governance. And I think the bottom line is really saying that there is a strong interest in this space because the percentage for the team will vary from one year to another depending on the interest. And an existing responsibly investing investors show strong loyalty. 47% plan to increase their allocation, while 47% also plan to maintain current exposure. So these clients are usually long-term clients. They invest based on their value, so they usually invest for the long haul. So we believe that responsible investment is not just a niche as it was at the beginning. It's now a growing client expectation. And then the reality is that the younger generation are really leading the way. They exhibit higher level of interest in this space. They also exhibit much higher ownership than the older generation. So, and then since they're about to inherit a lot of assets, we believe it makes sense for advisors to kind of, pay attention to these trends. Because the responsible investing can not only help deepen client conversation beyond performance, and it's also a way to really hit and go to the core of what's important to your clients. And then I think that, basically enhance your relationship with your client and deepen that relationship and grow trust. So it's a way to retain current asset, attract new clients, and also secure future assets. Turn your trust into growth. What we see is that Canadian investors actually trust their advisors. 68% of Canadians work with financial advisor. 84% says that advisors are important source of responsible investment decisions. So they really look up to you when it comes to making this decision and getting the knowledge. And then advisor guidance and past performance are still the top factors influencing responsible investment decisions. So we think this is huge and a good opportunity for advisor because you're basically the most trusted source for responsible investing. So be proactive, diversify, and grow your practice with sticky asset. Bring up the conversation. I know most advisors are more passive in this space, but based on all this number, we really believe that advisors should be more proactive in the space to attract and those clients that are interested in value-based investing. I like this chart, and then I put it in all my presentation because the RIA bring it up every year, and then the numbers are still high. This is basically saying that 73% of investor want value-based questions or responsible investment to be mandatory questions as part of the KYC process or client reviews. So I think this is massive. This is basically client telling you that they want this type of investment into their portfolio, and they want their value reflected into the investment. And then, as I said before, the younger generation are really leading at 80%. And, it's interesting looking at the numbers this year versus last year's survey. So last year, it was 77% of women, 74% of men that feel this way. And then now I see that the numbers are the same this year. So really showing that it really go beyond, and then it's more a need that is from on both ends, basically. This is another good chart because again, it's showcasing the responsible investment service guide that I mentioned at the beginning. So as I said, 73% of clients wanted this question to be added, while you're interacting with them and then questioning them through the KYC process. But only 28% are saying that advisor actually proactively ask the question. So there is a 45% of clients that want to be asked and then that are looking forward to investing based on their value. So this is a huge opportunity for advisor, and the numbers really speak for themselves. So now let's change gear here and then talk about what we believe is a successful advisor map to kind of really capture all these different opportunities. So the first point is we really think that advisors should engage the next generation early in the process. And then I think timing is everything, because you never know when a woman's going to inherit. You never know when the children's going to take over or when their parents going to pass. So I think engaging in the process early is key here. And then the number also showed that only 27% of heirs say that they will retain the current advisor, and then that drops to 20% after inheritance occur. So timing is really everything from this aspect. Successful advisor, what we find, are engaging heirs before the wealth transfer occurs. And multi-generational planning can strengthen retention, referrals, and asset growth. So we really believe that this is not just a transfer of wealth, it's also a transfer of relationship, which is, a key for the continuity of your practice. How to position yourself for intergenerational wealth transfer. As I said again, strengthen relationship with the next generation, create entry point for family conversation, bring up the younger generation. So this could be maybe when the child has a new job, that's a good moment to bring them in, to show them how they can save, showcase the power of compound interest, have different workshop for the younger generation. There are different ways of doing this, but I think the key here is really to engage them early. And then maybe now you're engaging all the younger generation from your existing client, and you're creating another community of, future clients around your practice. So we believe that positioning yourself for long-term continuity is really key. The second point is lead with value to differentiate your practice. We've just been through a couple numbers really showcasing that Canadian investors are interested in the space. They want this reflected in their portfolio. So ask the question, be more proactive. We believe that advisor who lead with family planning, value-based conversation can really stand out. Meaningful conversation create deeper client engagement, because you're really, as I said, going to what's important to them. And then I think that will grow trust and then deepen those relationships. We believe that differentiation today can drive stronger growth tomorrow. Win female and younger client through value-based advice. Those both segments, and then we see even male are interested in the space. The reality is that the next generation is not just about return or about understanding, or about an advisor who understand their need when it comes to money, but also what matters to them. So we believe that, incorporating value-based question into your strategy will be a value add. And then it can also strengthen relationship and align. I think it's important to align advice with what matters most to your clients. We also believe that portfolio differentiation matters. Traditional portfolio may not fully address evolving client priorities. So we believe that having differentiated solution that kind of take into account value-based investing can not only mitigate risk, so from a risk perspective, but it can also enhance core allocation. I work with different advisors, and I see advisors using our strategy differently. Some really just added into their portfolio model for risk mitigation, because most likely is different from what they're using, and hence core allocation. And some are really big on responsible investing, and they see the value and the opportunity, so they're proactive in the space. So for them, it kind of makes sense to have a solution that align with those needs as well. We believe that thoughtful portfolio construction can not only attract, but it can also retain and engage clients. And portfolio design is now a business development tool. I see a lot of advisors that kind of have a section about responsible investing in their website, really showcasing and mentioning to client that they're able to assist them if this is something they're interested in. So I think that's a good marketing strategy as well. We also believe that it's important to adapt to evolving client expectation. As we discussed, clients increasingly expect advice beyond investment alone. Value, transparency, and purpose are all shaping decision. Holistic advice is key. And the thing is, I see a lot of advisors that actually have a holistic approach when it comes to servicing their client, and then they really cover things that are important, like tax planning and all that. But I think what I see the difference between successful advisor and then those that maybe sometimes end up losing client is the way they're articulating that value proposition. I think it's really important to remind clients what you're doing for them, and then really highlight the value add that you're bringing to the table, so that they're aware and they recognize what you're doing. And I think meeting evolving needs support not only your fiduciary duty but future growth, because if you're asking all this question and you're really going to the bottom of what's important to the client, you're definitely doing your part of the job there. So at Genus, we have been in the responsible investment space for more than 35 years. So we're always innovating, and we have all type of solution from light green to darker green, depending on client need, because our goal is really to meet our client where their values are. Today we'll go over the high impact equity, which actually integrate the three spectrum of responsible investing. And it's a global equity solution with purpose, and also provide a great alpha. And it's a global equity solution with differentiated holdings. So I see a lot of advisors using it with the traditional allocation to make sure they're mitigating risk, because most likely it will be different holdings. So as I said, it's designed to complement that traditional equity exposure. It's value aligned investing with measurable impact focus. It's a strong fit for that younger generation and female that are value-based investors. And we believe that he help advisor connect purpose with performance. I always say to advisor, would you have a recommendation for a product that is both aligned with your client values and have performance, and have the client say, no, I'm not interested in this? Most likely they'll be like, of course, yes, I'm on board. So all things we believe that this is a solution for that segment of the population that are interested in value-based investing, and then also a way for advisor to just complement their traditional sleeve. So I will now pass it to Steph for her to go through our sustainable approach, and then how that's adding value to Alpha.
Thank you, Soren. Thanks so much. So I think it is good segue into, we talk about the solution and how it could be a way to kind of deepen the bond and conversation with your clients. And so yeah, now becoming kind of we are segueing to what the product is, what the solution is. And so before that, I would like to kind of touch on who Genus is. So, and how we have evolved in the space of sustainable and impact investing. And Genus, we were founded in 1989, so I think about 37 years. And very early on in 1994, we created the first sustainable investment portfolio, and that is for one of our longstanding high net worth clients. She is a very well-respected trailblazer in the space today. And early 2000, we onboarded a couple of environmental foundations based in BC, and 2005 is a very pivotal moment. We onboarded a very well-regarded leading environmental foundation, David Suzuki Foundation. I'm sure many of you are quite familiar. And in 2010, we worked closely with them to divest heavy carbons from their portfolio to achieve that value alignment with their missions. And that also led to the creation and the launch of our fossil-free suite of funds covering fixed income and equities. 1 year later, we launched the first in Canada high impact equity fund, which is the one that we are kind of focusing on today. And 4 years later, we also further established the Impact Investment Council. Essentially, it's a fully customized impact investment management services covering private and public asset classes, mainly for accredited investors. And then after that, to kind of facilitate total impact measurement, we created the Net Impact Score. 2021, we launched the Global Impact Bond Fund. And 2023, we were the first. And right now, we believe, based on our research, we are still the only investment manager in Canada that has incorporated a screen that looks at community relations with Indigenous communities in public equity offerings. And then most recently, last year in September, we also launched a commodity fund. And this fund has also incorporated a lot of sustainability considerations in the design of it. A very key foundation of the solutions that we are providing is our sustainable investment approach. And there are essentially 3 different strategies, and screening is one that is one of the very key one. And within screening, we have positive screening, negative screening. And all of these screens, they are mostly driven by value alignment or risk management. There are a few key categories of screens, and so number one being fossil fuels or carbon-related screens. Essentially, we screen out companies that own any fossil fuel reserves, companies that are engaged in the extraction, processing, or transportation of fossil fuels, companies that are highly carbon intensive. In a very extreme case, an example would be coal-fired power plants. And then we also look at a business or a company's revenue and also ownership exposures to harmful businesses. Typical examples, as you know, weapons, even support services and systems, and alcohol, gambling, tobacco, adult entertainment, those sinful or harmful industries. And then we also look at how these companies actually engage with all the stakeholders through controversy screening. So essentially, companies that are involved in severe or widespread controversies in different E, S, and G areas, they will be screened out. And then we also have a collection of screens that are kind of collectively aiming to improve systemic sustainability. For example, we look at banks or financials, the amount of financing to the fossil fuel sector, child labor within their supply chains or their own operations, and also biodiversity, and also even recreational cannabis screen. And finally, on positive screening, we look at how a firm or a company is really kind of promoting, or at least being consistent with promoting social equality. And also, we have a very strict and clearly laid out impact requirement, looking for companies that actually contribute a meaningful positive impact to either the environment or the society. And then the second key strategy is ESG integration, and that is really leaning on Genus' strength. And we are a quant investment manager, so we have our proprietary research platform, our capabilities to do extensive, robust research and to find alpha, basically. So this is where we incorporate ESG factors in our investment analysis, investment selection to improve risk-adjusted performance using ESG factors. So we have an ESG alpha model, and this is that is basically looking at different ESG factors, and they are fully integrated into our traditional multi-style security selection model that are targeting to improve risk-adjusted performance for the investments that we look at. And then finally, shareholder engagement. This is different from screening, which is more like divestment. And this is where we still want to, through dialogues, engaging with these companies to bring about long-term positive change and to improve their corporate ESG practices. So all these coming together, they are all influencing our investment decisions and portfolio construction for the high impact equity strategy. This is just like a deeper dive into like some of the different categories that I talked about for a negative screening within exclusion and inclusion. We talk about gender equalities and reducing inequalities, and also for ESG rating. This is also one of our key screens. And within ESG rating, there are many different areas that are relevant for different industry, and kind of laying out, which areas that we will look at in terms of risk exposures, opportunities exposure, and how management of companies, they are managing these risks and exposures. And so that is a more comprehensive list of screening. So when we talk about impact investing, impact measurement is a very key element. So for our impact measurement, we leverage the framework of United Nations Sustainable Development Goals, in short, UN SDG. As you may know, UN SDG is a set of 17 goals adopted by all the member states of the United Nations in 2015. Collectively, these goals, they are hoping to promote overall economic, social, and environmental sustainability for everyone on this planet. And this has become a very widely used framework in investment industry for impact measurement, owing to its simplicity, transparency, and also it is actually very, very easy to understand. And for us, the way we measure impact is by looking at a revenue exposure of a company that is coming from its products or services that could be contributing to or taking away from different UN SDGs. And we also recognize every investment makes a positive impact, negative impact, or something neutral, or combination of the three. So when it comes to impact measurement, it is extremely important to take it holistically. And this is why we created the net impact score to take into account of both positive impact and negative impact of an investment. The ultimate goal is to really ensure that while we are within this strategy, we are selecting investments that contribute a meaningful positive impact benefiting the world, but we are also not causing harm in any other unintended areas. So these are some clients that we work with, and many of them, they are in the public foundation space. A couple of them, they are in the private foundation space, but all of them, they are leading organizations in Canada or even in the global stage that are promoting different environmental or social outcomes. And many of them are very prominent impact investors in Canada. As you may know, we talked about David Suzuki Foundation, Make Way Foundation, and near home, we have Habitat Conservation Trust Foundation. They are really kind of adamant in protecting the natural habitat. We have First Nation clients, and also Peter Guggen Foundation. It's based in Toronto. They have done so much good work in the healthcare space as well. And then I think previously, Seren also touched on it, on the High Impact Equity Fund. So I would like to kind of use this platform to kind of lay out what this fund really is. So it's an active global equity solution, and we mainly invest in mid and large cap companies that are proven, innovative, that are also contributing through their products and services a very meaningful impact, benefiting either the environment or the society. And this fund is targeting 100% global equities. So we have a benchmark MSCI World, and also very importantly, it is a fully liquid strategy. Daily liquidity, you could get in and out on a daily basis as you need. And this one is the first in Canada. We are almost crossing the 12-year track record mark within the next 30 days. And in terms of like, as the name suggests, is a high impact strategy. So we do have a very high impact requirement imposed at the portfolio level and also at the individual stock level. So at the portfolio level, we do require there is at least 50% positive impact with no negative impact. And as I mentioned, in terms of impact measurement, we look at the revenue exposure to derive that impact level. And then finally, we have incorporated within this fund not just looking for good companies, we are also screening out the bad actors through all our standard fossil-free screening that I talked about earlier to ensure that the strategy is low carbon, social responsible, and also kind of taking care of different aspects of the overall systemic sustainability and social equality. Suren also touched on this, but I want to highlight here, this fund, it is slightly different because it is a bit more concentrated strategy. For good reason, we can only invest in really impactful companies. So typically we have about 40 to 45 stocks within the portfolio. And it is also why it is also less correlated with a typical broad equity benchmark or broad equity market. And so for example, this fund, historically, it has a market risk level. We use beta. I'm sure many of the advisors are very familiar with the concept. And so we have a beta of about 0.8 to 0.9. And so what it means is on average, we have about 10 to 20% less market risk. And market risk or beta is basically a measure of a portfolio's return sensitivity to the underlying benchmark's returns volatility. So lower meaning it has lower market risk and lower correlation. And so on the chart on top left-hand side, it basically shows during times when there's exacerbated volatility, and we have highlighted some calendar years, except for 2016, only the first 3 months. So 2020, we all know it was around, I think it was around March, that was the kind of outbreak of the COVID crisis that became really kind of uncontrollable, and market experienced quite a bit of drawdown, although after that, the market came back up, but overall the year was down from previous year. And during that year, market MSCI World gained about 14.5% overall, and we were gaining about 24.3%. So that is almost a 10% outperformance there. Another example is in 2022, it was a very volatile year on the downside. That is a combination of factors: energy crisis because of the war between Ukraine and Russia broke out, and also decades high inflation, aggressive central banks interest rate hikes. And so basically the whole year market was down almost 12%. And that's the year that we were down to, but we were down by 2.7. So almost really much dampening the downside volatility, outperforming by about 9%. And fast forward to most recent quarter in 2026, we all know on the last day of February, the war between Iran and US broke out. Much of March, we have seen so much volatility on the downside for the market. Energy crisis came back. And so overall MSCI in the first quarter of 2026 was down 1.7. Our fund was able to actually gain 3.6, outperform the benchmark by about over 5%. And touching on the beta and lower correlation of this strategy. So we do, for example, 3-year beta is 0.85. And so another kind of a statistic showing that this fund could be a very, very good diversifying kind of addition to your overall equity or overall balanced portfolio. And then over the longer term as well, so it's not just kind of in certain segments of the history, but for example, last year obviously is a good year, 21% return. But then over the last, for example, 5-year on average is about 10.6% return, and over the last 10-year is 11.5% per annum. And so we talked about like a more kind of overarching perspective. I just want to give you like maybe a bit more flavor about what's driving the fund in the most recent quarter as an update, and for some of the advisors. So in the Q1 2026. The high impact equity fund in US dollar terms gained 1.95%. Benchmark actually lost 3.47. So total active return or total outperformance or value add is about 5.42%. So of this 5.42%, there are a number of contributors. The biggest contributors for this quarter is risk factors or style selection. That is a combination from our positioning or overweight in momentum exposures that we have a lower beta during the quarter really helped. And more importantly, some of the ESG factors that we have more positive exposure, they are doing really well. So in the small little box there under ESG factors, these are the 4 sustainability or impact factors that we track and measure for our performance. And all of these, social impact, environmental impact, higher ESG rating, and lower carbon intensity, they are all adding value, especially environmental impact is adding 0.7% in the first quarter. And then industry selection also did well, and we have been overweight industrials, utilities. They have been doing very well, and also we in the first quarter we underweight financials and also IT. And a specific stock selection we've done well, also 1.82%. I'll give more details on some of the examples of the top performers later. Yeah, so this is another, also another kind of performance attribution. I won't go into detail. It is very similar pattern, but this is over the last 6 months from end of September to also end of Q1. And for overall this 6 months or semi-annual period, the fund outperformed the benchmark by about 8.92%. Again, style selection, it's one of the biggest contributors, and also industry selection is also gaining a lot by through overweight in healthcare, industrials, utilities, and materials, and also for style selection, very similarly lower beta, momentum exposures, and a lot of these sustainability factors are really adding value. And so here is the sectors and regional exposures with overweight or underweight positions versus the benchmark. And so this is how this is showing how we are positioning versus the benchmark, where we are taking bets. So on the left-hand side, we are seeing we are most overweight in healthcare, utilities, industrials, and real estate. We are more flat or neutral versus the benchmark in terms for consumer staples, materials, and consumer discretionary. And we are very underweight financials, communication services, energy, and IT. And so this is positioning as of the end of March. But I want to highlight one point is that the collection of overweight sectors, the collection of underweight sectors, they don't really change a lot from quarter to quarter. The key reason why is this is a high impact mandate. And so we structurally tend to overweight sectors that are higher impact. For example, healthcare and renewable utilities is what we are referring to here, and some of the industrials that are enabling electrification or decarbonization or infrastructure building, and sustainable real estate. Those are the typical overweight sectors. In the past, we have seen a bit more overweight in material sector, usually coming from sustainable forestry. But as you know, sustainable forestry, sustainable lumber, or basically the whole lumber industry has been, under a lot of stress. A variety of reasons, tariffs and macroeconomic conditions. And so we are kind of leaning more towards neutral. And then moving to the underweight sectors, financials, it is very hard to find impactful banks or financial company that we could invest in. And so you will see a very high underweight in financials, because financials as a sector itself, the benchmark weight is around 17%. So we are seeing that number regularly, and for obvious reason, communication services, they're not inherently a very highly impactful sectors, and also IT, except for a few names. And then energy, for obvious reason, we don't invest in fossil fuels. And then in terms of regional exposures, we tend to overweight Europe because and Far East and Australasia, because they do have a higher number of impactful companies, especially some of the industrials, some healthcare. And then for Canada and US, we tend to kind of more to be more neutral or underweight. Recently, for US, we do see there are a few more kind of industrial companies that are doing quite well in terms of adding impact in energy efficiency and decarbonization. And some healthcare names are also doing well. So we are seeing a bit more kind of, instead of more underweight, now we are having a position which is more neutral. These are some top holdings based on these different holdings' absolute weight within the portfolio. But then we have also accompanied the portfolio weight with the active weight. And if you look at the active weight, this is where you actually see where we are having high conviction. And so, for example, here, NVIDIA, it's the highest holding within the fund. But because NVIDIA itself is very large cap, so compared to the benchmark, the active weight is only 19 basis points or 0.19%. So which is actually more closer to neutral. And many other names, Solaria Energia, it's a renewable energy company, a lot of industrial companies and some healthcare companies here. And the active weight is usually around 3 to 4%. And so we are, these are the names that we have more conviction. And they have been doing well. So as you can see here, this is the top 10 performance of the fund over the last 6 months. There are a lot of overlaps between this top contributors list and the top holdings list. For example, Solaria Energia, ACS, GE Vernova, Gilead Sciences, BorgWarner, and also ADI. These are all the kind of top holdings within the fund as well. I would like to spend like the last few minutes talking about some of the real companies that we invest in to give you a bit more flavor of what the fund is. So this is GE Vernova. It has done well, and we have liked this company for a while. And so this is a US-based, but a very global energy equipment company. It innovates, develops technologies to build sustainable power system that can basically enable broad-based decarbonization and electrification. This company has a net impact score 28%, mainly coming from its renewable power system and also associated services, contributing to affordable and clean energy, UN SDG number 7 and number 13 climate action. This company also has a very high financial ranking within our model and ESG rating of AA. It has very strong governance, and also most of its revenue kind of involve clean tech, so that's why it's contributing to a very good rating. And so overall, this company has done well as well financially. Next one is BorgWarner. All good. BorgWarner is a consumer discretionary name, and this is auto components. It is in auto components industry, and it basically provides clean tech solutions for combustion, EV or like hybrid vehicles. Its legacy business includes some kind of energy efficiency enhancing products or key components such as turbochargers or other key products for EV and hybrid, such as battery systems or electric motor. This is a very good transition play, but not a pure play EV stock. And it is also one of the most sustainable automotive suppliers out there. For this company particularly, it has 35% impact, meaning 35% of its revenue is coming from products and services that are kind of reducing energy footprint or enabling the electrification in the auto industry. And it has a pretty good rating, AA as well. It has also a very good financial ranking within our model. And as a firm, as a company, it has also reduced its operational emissions as well. In 2024, it has reduced its operational or GHG emissions intensity by 46% versus baseline year of 2021. It also has done a lot in terms of minimizing waste. So for example, in 2024, they have actually recycled or composited at least 91% of their waste. Solaria Energia, and this is a Spanish renewable energy company, and they almost exclusively focusing on solar PV power generation. They designs, develops, builds and owns and even operates a lot of these large-scale solar power plants, mostly in Europe, and kind of operating like an independent IPP, independent power producer. They have a very high impact score, 99.8%, meaning almost 100% of this revenue is coming from renewable energy production, contributing to climate action and affordable and clean energy. It has the highest ESG rating, AAA, and also a very clean controversy record, almost a perfect 10, no controversy flagged, and very high financial ranking as well. And some other interesting things that they're doing currently, they are also developing some kind of projects combining agricultural production, and also solar power generation on over 190 hectares of land as part of their agrophotovoltaics projects. These projects are specifically designed such that crops and livestock and even solar panels, they can coexist, and really kind of helping to boost responsible consumption and also production. Finally, United Therapeutics. I think this is a very interesting one as well. United Therapeutics, it's a pretty innovative US biotech company, and focusing on developing therapies for serious or life-threatening diseases. Often those are for rare or underserved conditions where clients or where patients, they have limited treatment options. For example, one of they are best known for the drugs that improve blood flow into the lungs and hearts, which really help these patients breathe better and function better. And also, it is the first publicly traded biopharmaceutical company to become a PBC, public benefit corporation. So a PBC is a legal for-profit entity where they are structured to balance shareholder returns and also social or environmental mission. All of the directors of a PBC, they are legally required to consider the impact of the decisions and all of the stakeholders, not just shareholders. So I thought this is a very meaningful background to this company. It has a very high impact, 99.2%. So 99.2% of their revenue is coming from these serious disease treatment, helping to promote good health and well-being for, in 2024 alone, it has helped over 15,500 patients, including the 500 lung transplant patient. And they also have done a lot in terms of reducing the waste as well for packaging of their therapeutics. So so that kind of conclude the section that we talk about the fund, and we will have some time for questions later, but I'll pass it back to Saran to talk about to have the closing.
Awesome. Thank you, Steph. That was great, actually. It's always good to, see some of the holdings that are, contributing to the fund and in the area that the different company are making an impact. So we went through a lot of information today, and hopefully, it was helpful to the audience. But I mean, try to remember everything, but if you don't, there is really 4 takeaways here that I want to leave you with that we think it's important. As we said, we see an opportunity for advisor to really leverage on this in this space and then help clients that want to invest with their values. So a couple of key takeaways here for us is we really believe that it's important to build relationship with the younger generation early in the process. And as I said, the word early is really key here, and then to create that multi-generational relationship before wealth transfer occurs. We also believe that it's good to lead with value. The research and all the numbers are showing that Canadian investors are really interested in invested in the responsible investment space. We think you can also win younger and female clients using value-based conversation to really identify what's important to them. We believe that having a portfolio differentiation will help you grow by offering solutions that are different and that also align with client priorities. And then, it will basically provide you with that added value. We strongly believe that advisors who are building stronger relationship today, will have building deeper relationship today will have better results in the future. And then, that it's really important to align with what's important with clients' values. And then, as I said, partnering with Genus kind of makes sense if you want to invest in this space, because we have been around for more than 35 years. And then we have been innovating in the space. And then we believe we can really help your client invest based on their value. So now I'm just going to turn into the chat to see if we have any question. But I also wanted to add that we, of course, understand sometimes when I talk to advisor, I hear that, the responsible investment space is such a broad space. It can be cumbersome. What's sustainable from one to one client is different for another client. And then we're really here to partner with advisor to provide you with the tool and the knowledge that's going to help make those conversations a little bit easier for you. And then, as I said, we have numerous of solution that can kind of help fill the service gap in this space. So I believe we have a couple of questions into the chat. Let me see what I see. Okay, I have one question here, Steph. How can we confidently explain to clients that this is not greenwashing? And what's the simplest way to communicate your process? It goes back to what I was saying, that it can be sometimes cumbersome or, intimidating for advisors to kind of go into this topic. But I'll let you answer that, Stephanie.
Sure. Yeah, thanks, Suran. A great question here. Number one, for our whole process and, some of our criteria in, for the construction of the fund, it is well documented internally and also in our disclosure statement, also in the prospectus. So everything is laid out very clearly. In terms of communicating to, our advisor friends and or even the clients and clients, we do provide very extensive reporting. So basically, we promise that the fund will do A, B, C, D, E, and then we provide reporting on some of the key sustainability factors that showing how our fund is really stacking up versus, some of the standard metrics are based on the benchmark. So then you see that we are actually doing what we are set out to do. And so it is also important for us to back up all the data and why we are, excluding this or including that, and because it is quite important from a regulator point of view. And so we have been doing that. Some clients, they like to, we have also worked with clients where they have, specific metrics that they would like to see how the portfolio is doing. To the extent that data is available, we can always provide those data for you as well. And sometimes we even offer, because sometimes it's like a lot of information for our end clients, for advisors. And so we sometimes even offer doing a portfolio audit in terms of different ESG and impact metrics to look at your existing portfolio. And so then you get an idea what your existing portfolio is doing versus what you could do better otherwise. So these are the things that we often work with our clients and advisors to help alleviate some of the concerns about greenwashing.
Yeah, and thank you for that, Stephanie. And I think that's one of the things that I hear a lot with advisor. They really like that reporting because it's an easy way to kind of showcase client which area their portfolio is making an impact on a quarterly basis. I have another question here. What happens when a company in your portfolio no longer meets your sustainability criteria? Do you engage or do you divest?
Thank you. So yes, very simply, because we do have very clearly laid out set of criteria that we follow, especially on the screening part. And so if a company is found to fail certain criteria that we have set out or laid out within the strategy, then they will have to be divested. But having said that, it doesn't mean that we don't engage with them, because this very company, if they are still good financially and other, in other aspects, this company could still be in our other funds, which is, we call them conventional funds, or the more responsible investing funds that have kind of less stringent screening criteria. If this company is still in those funds or in our other segregated accounts, we will still engage with them through our partners shareholder association for research and education. So so the answer is yes, we divest from this fund because we do have very strict criteria, but then it doesn't mean that we don't engage with them.
That's good. It's good to know that there is both aspects and then both way of basically dealing with this type of scenario. I have another question here. Can you give an example of holdings that might look controversial at first glance and explain how they fit within your framework? I feel like that's the big elephant in the room sometimes, but yeah, good to address it.
Yeah, not recent, been a while. Ever since the rise of AI. And so I do get questions from clients quite a bit on NVIDIA. It's the most prominent, one of the most prominent semiconductor company. And so clients were like, why do you invest in NVIDIA? And they, like they are a semiconductor company. AI, has such huge energy demand and huge energy footprint. So why do we invest in it? So I think you have to think about, what's the next best alternative. So very simply, NVIDIA's chips are very energy efficient for a fact, and that it really reduces greatly the energy footprint of AI applications. So for example, if you look at the sustainability report, and they have the Blackwell GPUs, they are up to 50 times more energy efficient than a traditional CPUs. And traditional CPUs is essentially the next best alternative. So AI is already kind of in everyday's life, everyone's everyday's life, and students, teachers, households, companies, government, they're all using AI into various degree. The best analogy is buildings. We all need buildings to live in, to function, and they are very energy intensive. But then having energy efficient materials that could reduce the energy footprint of these buildings is also very important. And so that is kind of like, yes, AI does use a lot of energy, but these chips from NVIDIA, or for example, from AMD, just other semiconductors, they are actually really helping to reduce a lot of the energy footprint of AI applications. So, for example, NVIDIA, they do have 88% of positive impact. They have a pretty clean controversy record as well, and a good ESG rating. And so, the point is, a lot of its revenue is coming from these chips that are really helping to reduce the energy footprint of AI.
Okay, that's good to know, because that's the number one question I feel like we always get about NVIDIA. I don't think we have any more question, and I feel like we're coming up to the end of the session here. So I think we're gonna wrap it up for today. Just want to take time to thank everybody for joining the webinar today. I know advisors are very busy. Thanks for those who are, for all the advisors that are supporting us. And then if you're new to Genus, feel free to reach out. We'll be happy to continue the conversation. Our next webinar will be about dementia, diminish, and family planning. And then that session will bring together perspective from wealth management and elder law to help individuals and caregivers understand how to prepare for and respond to the financial implication of dementia. I think it's a very hot topic. So a recording of today's webinar will be sent to you via email, and it will also appear to our website under the advisory link. So if you have any question, feel free to reach out to us directly, and we'll be happy to continue the conversation. So enjoy the rest of your day, and thank you again for joining. If you don't mind, please stay. I believe we have a quick survey, and then we're always happy to hear your feedback and see how we can improve this session. Thank you for your time today, and have a wonderful day.